Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and compelling investment opportunities. Discover what's next at ausbizcapital.com.au. This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Good Monday morning. Lovely to be here with you on the 16th of June. I'm Nadine Blaney. And look, there is a lot for investors to be taking on board today. A 2-month rally faltered on Friday. We've got the ASX expected to come under pressure after Israel launched a military strike on Iran and Iran filed missiles in response. So the fighting does continue, with further civilian casualties being reported on Sunday. So Friday, major U.S. indices ended down over 1%, the S&P 500 falling 1.1%. It is up 1.6% so far this year, but a 20% gain since the low achieved on April the 8th. Oil prices surged nearly 7% on fears the conflict could disrupt crude supply from the Middle East. U.S. energy stocks rose in tandem. Gold miners gained as that Middle East conflict fueled safe haven demand. Look at Newmont, up by 3.5%, AngloGold Ashanti up by more than 4%. Defence stocks climbed, Lockheed Martin amongst them, Northrop Grumman as well. Airline stocks fell on fears that fuel costs could climb. So in other news, Adobe shares fell on concerns that the pace of the company's AI adoption is too slow. Oracle, though, jumped to a record high for the second day on an upbeat forecast. While the Iran-Israel conflict dominated, there was still a bit of economic news to get across on Friday. The University of Michigan Consumer Confidence Survey improved for the first time in 6 months in June, even amidst trade uncertainty. However, households worried about the economy's trajectory. This week, the Fed's 2-day monetary policy meeting looms large. It's widely expected to hold interest rates steady. However, investors are looking for any hints about whether the Fed might lower rates in the coming months. A drawn-out conflict, though, in the Middle East and elevated oil prices could complicate the inflation picture further. The U.S. government bond yields climbed on Friday. The U.S. 10-year Treasury yield rose by 5 points to 4.41%. Currencies were mixed against the U.S. dollar in European and U.S. trade. An escalation in the conflict would likely weigh on the Aussie dollar against the U.S. dollar and major crosses. So as we mentioned, the oil price surged 7% Friday on the escalation of the conflict between Israel and Iran. U.S. NYMEX crude rose 7.3% to $72.98 a barrel after jumping over 14% at one point in the session. The Brent oil price surged by 7%. Gold futures settled 1.5% higher to $3,452 an ounce. Spot gold trading near $3,432 at the U.S. close. For the week, gold jumped 3.2% and is nearing another record high. Iron ore, copper, and aluminium prices all fell. Well, let's get more on what all of that means for U.S. equities, and Chad Padowitz, CIO of Talaria Capital, joins me now. Chad, look, the landscape did change on Friday with Israel's attack on Iran and now the tit for tat going back and forth. Does this geopolitical risk change your view as to, importantly, what will happen in terms of U.S. economic growth and the Fed?
Yeah, good morning. Well, look, geopolitics have been quite complicated and difficult, I guess, for quite a while now. It's not a new thing. And generally, the market as of now has tended not to focus or be too concerned about these things because they haven't really been big, effectively GDP areas. So depending what happens in oil price, I think that's the big take. If oil stays and it's elevated a little bit to around 75, and which actually isn't that high relative to where it was even some months ago. But if that were to go all the way to 90 or 100, I think that will have a significant impact. Given inflation's already quite high and interest rates are quite high already, I think that will have a significant impact on expectations on growth and actually equity values. But if it stays sort of around 75-ish and it doesn't expand and bring the US into it in a big way, I think the reality is the market, I think, will be more driven by earnings and growth expectations, which we do think create their own challenges and valuation as well. But I think that will stay more important in that scenario.
Okay, so ground zero for any lingering impact of this Middle East conflict will be oil, right? But you did mention earnings, because so far so good for earnings. I mean, we haven't seen the impact of tariffs to a large degree yet. We haven't really seen, the impact of any recession or recessionary fears on earnings as well. So when does that come home to roost?
Yeah, well, it's quite early to see the impact of tariffs just yet, because they've only recently been increased, and there's been, as you know, some pauses on a few of them while they've negotiated trade deals. So I think you will start to see more of an incremental impact in the June earnings season, which will start in about a month's time from now, and certainly into the end of the year. So I think it is too early to say no issue on tariffs, as in, I think there is going to be an issue. I think if they don't bring those levels down, it does help inflation stay high. It does create an issue with productivity. It creates a whole lot of issues if that will show up in earnings. But I think in a month or so we should get a lot more clarity on the extent of that.
Okay, when we are thinking about the investing landscape in general, I mean, there has been this notion that there's a Fed put for so long. It's as if investors believe that it will be there forever. Is that true?
Well, I cannot speak to what investors in general will, believe, but I do think there has been a concept of a Fed put for quite some time, as you say. However, that's generally happened over the last 20 odd years in an environment of very low inflation. So you were able to reduce interest rates because inflation wasn't a problem. I think it's a very different thing when inflation is still quite elevated, and you lose all credibility as a central bank when you drop interest rates into a higher inflation or relatively high inflation environment. So I think relying on a Fed put is a very risky thing. And I don't think it would be prudent to invest on the basis of that of helping you out.
All right. So then you want to stick with the fundamentals. You want to stick with quality. You want to stick with, I guess, cash flow. You want to talk about valuations and stick with valuations. So is there an example of a stock that you think fits the bill right now?
Yeah, well, I mean, one company would have oil is obviously in the news a bit at the moment, but even before that, it is an oil company, but it does fit a lot of those things. Is a Canadian company called Cenovus. They produce almost 1 million barrels a day. So in the global context, that's all about 1%. So it's not a small company. 25 billion market cap. But even at oil prices, not today's oil prices, but where they were like a week ago, it's sort of in the high 60s. They were over a 10% free cash flow yield, providing that all back to shareholders in dividends and buybacks. Negligible debt, 50-year plus reserves, $25 cost of production, or under $25. So they obviously had a pretty good day in the last yesterday or Friday, but we do think that's the type of company that will do quite well in what is quite a difficult valuation and economic environment.
Okay, and so the tailwind of the oil price is neither here nor there when it comes to your assessment of this company then?
Yeah, look, obviously they are an oil company, so oil prices does have an impact, but the way we see it, their cost of production is under or 70 or 90 or 100, they will make obviously more of it. But we've looked at, at $60 a barrel, they make over 10% free cash flow yield. And we see that as a very sustainable price because of, we look at marginal cost of production. So obviously oil price does have an impact, but we're not requiring, or the investment thesis and the path to a very strong return is not required.
All right, Chad, it looks like our line has just become a little bit problematic, so we'll leave it there, but we did get the gist of the investment thesis coming through from Chad Padowitz there, CIO of Talaria Capital, and that was, looking at Cenovus Energy. It's a Canadian listed company. Look, we will be keeping our eye on the energy plays with much interest. Gold as well. We did have gold inching towards a fresh record high, with Bank of America calling $4,000 per ounce possible in the next year or so. SPY futures, though, pointing to a drop of about 20 points or 0.25%. We'll get you caught up with all the latest, plus the company news, on the other side of this very short break. Stay with us.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence. The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.